Today, I'm going to share 10 dividend increases you need to know. Dividend growth is one of the most important metrics to look at if you are a long-term dividend investor. Not only do dividend cuts and increases correlate to how profitable a company has been as of late, but they signal how a board thinks the business will perform over the following year. A high dividend increase is often a vote of confidence in a well-run company. In today's video, I'm going to share 10 stocks which just increased their dividend over the past month. Some of these are higher yield, low growth, and others are lower yield, high growth. With each, I'll provide a brief updated stock analysis. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Please sign up for my free email newsletter if you want help finding better dividend stocks. Every Monday, you'll get the latest dividend increases, decreases, and special dividends straight to your email inbox. On top of that, you'll get tons of other valuable stock analysis and lessons from legendary investors. Link in the description and pinned comment. Stock number 1 is Texas Instruments, ticker symbol TXN. They just declared a $1.36 per share quarterly dividend, which is a 4.6% increase. This has not yet been fully reflected on dividenddata.com as the news just came out. However, that would put the new forward annual dividend at $5.44, giving it a 2.67% dividend yield. The main thing you need to notice with Texas Instruments' dividend payment is that growth is slowing down. The new 4.6% increase is a continuation of this trend. Over the past 10 years, Texas Instruments has grown their dividend payment at a 15.79% compound annual growth rate. This has slowed to an 8.4% CAGR over the past 3 years. The prior dividend increase was 4.84%, and the one prior to that was 7.83%. And the reason for this is actually very simple. Since October 2022, Texas Instruments has seen their earnings per share decline consistently. EPS has dropped from $2.45 a quarter all the way down to $1.22 as of the latest quarter. On top of this, the company is spending more than ever building new chip fabrication plants. So the company is making less, but on top of that, they're spending more than ever. That's over $1 billion a quarter in capital expenditures. In fiscal 2023, that was $5.07 billion in CapEx. So with declining earnings and increasing capital expenditures, free cash flow for Texas Instruments has fallen off a cliff. In fiscal 2023, they only generated $1.49 in free cash flow per share. That was a 77% decrease year over year. And when you take that into account, it makes sense why Texas Instruments' dividend growth is slowing. Their payout ratio based on free cash flow came in at 337% in fiscal 2023. That means they paid out 3.37 times more in dividend payments than they had earned in free cash flow. That is not sustainable. However, when you exclude those capital expenditures and only focus on earnings per share, then the payout ratio for 2023 was closer to 70%. And it's for this exact reason why on dividenddata.com, I designed a payout ratio based on free cash flow. This is not found on many other investing websites. Free cash flow is the ultimate measure of what's available for a company to pay out to shareholders as dividends. I'd expect dividend growth to remain slow at Texas Instruments moving into the future. And it's for these reasons that I actually sold my Texas Instruments stock over the past year as earnings were declining and capital expenditures were increasing. In my opinion, I think the company is overvalued and does not deserve to trade anywhere near their all-time high in stock price. That said, if you own the stock and want to continue reinvesting dividends, just be aware that dividend growth may be slow moving into the future. Stock number 2, we have T-Mobile US, ticker symbol TMUS. They just announced an 88-cent per share quarterly dividend, which is a 35.4% dividend increase. T-Mobile is the best performing telecom company from an investment perspective. They do not have a lot of the legacy business that Verizon and AT&T are plagued with. They're hyper-focused around 5G and wireless internet. They're gaining market share, and their 2020 acquisition of Sprint only helped with that. The current annual dividend payment for T-Mobile is $3.52, giving it a 1.76% dividend yield. This is very sustainable at a payout ratio below 10%. Since initiating their quarterly dividend payment in November 2023, they now just performed their first dividend increase. This signals that they may become an annual dividend growth stock, and the recent earnings performance does back this up. Since 2022, T-Mobile has shown a consistent trend of growing free cash flow per share. Wall Street analysts are projecting continued earnings per share growth for T-Mobile all the way through 2028. These are high growth estimates as well, and it's currently trading only about 4% over the consensus price target among Wall Street analysts of $191.60. Overall, analysts are grading T-Mobile stock a buy. Let me know in the comments if you want to see a full stock review of T-Mobile. Stock number 3, we have JP Chase, ticker symbol JPM, which just announced an 8.7% dividend increase. This is the largest bank in the world. Their forward-looking annual dividend payment is $5 per share, which is a 2.37% dividend yield. They've had strong growth in earnings per share over the long term, and they're close to their recent all-time high in stock price. Since the great financial crisis, JP Morgan has seen strong dividend growth. The 10-year compound annual growth rate of the dividend is over 12%, and in the past 6 quarters, they've seen 3 dividend increases. The most recent 8.7% increase, with 2 quarters prior having a 9.52% dividend increase and 2 quarters before that having a 5% dividend increase. It remains to be seen whether this trend of growth will continue. Notice that from October 2021 all the way through July 2023, they did not raise their dividend, and from October 2019 through July 2021, they did not raise their dividend either. So they do not have a consistent pattern of growth, but I imagine the dividend will go up along with long-term performance of the company. Payout ratio is very sustainable at around 30% based on net income. However, it fluctuates a lot based on free cash flow, and that's because JP Morgan's free cash flow fluctuates a ton. For example, in fiscal 2021 and 2022, it was in the 10 to 20% range, but it was unsustainable in fiscal 2023. Let me know in the comments if you want to see a full stock review on JP Chase. I wouldn't mind doing it, as I do need to increase my knowledge around the banking business. For stock number 4, we have Microsoft, ticker symbol MSFT. They recently declared an 83-cent per share quarterly dividend, which is a 10.7% increase. If you follow the channel, then you know Microsoft is the top holding in my long-term dividend growth stock portfolio. It is currently the second most valuable company in the world, valued at $3.24 trillion. And the reason for this is because of their dominant market position and high earnings growth over the past decade. You can see the acceleration of their earnings per share since 2015, and fundamentally that is what has driven up their stock price in that same time. These increased profits have led to rock solid high dividend growth. The Microsoft dividend increases every year at 10% like clockwork. The forward-looking annual dividend is $3.32 per share, which gives it a 0.76% dividend yield. It's very sustainable at below 30% payout ratio based on both free cash flow and earnings per share. And again, the 10-year compound annual growth rate of the dividend is 10.35%, and you have the past 7 dividend increases all hovering around that 10% number. And there's absolutely no sign this will stop anytime soon. Wall Street analysts are projecting continued double-digit earnings per share growth through 2029, and based on the consensus price target among Wall Street analysts, Microsoft is currently trading at fair value. This is a company that I will continue keeping my eye on, and anytime there's a notable dip, I will be adding to my position. For stock number 5, we have Keurig Dr. Pepper, ticker symbol KDP. They just announced a 7% dividend increase. This puts their annual dividend payment at 92 cents per share, giving it a 2.46% dividend yield. Keurig is a quarterly dividend payer, and over the past 5 years, they've seen consistent dividend growth on an annual basis. Their past 3 dividends have been around this 7% dividend increase range, and the payout ratio is sustainable based on earnings per share and free cash flow usually, except for fiscal 2023, but it does seem like this will improve in fiscal 2024. Stock number 6 is Realty Income, ticker symbol O. This stock is incredibly popular among dividend investors, so much so that it's known as the monthly dividend company. They just announced a 0.2% dividend increase. O is a real estate investment trust that has seen strong performance over the past few decades. They have a consistently growing monthly dividend payment. In fact, they have multiple dividend increases throughout the year. The current forward-looking annual dividend payment is $3.16 per share, giving it a 5.13% dividend yield. And this dividend payment is sustainable based on free cash flow around that 73% payout ratio range. And high payout ratios like this are expected and normal in the real estate investment trust business. And if you're looking for reliably, slowly growing monthly dividends, Realty Income is probably the best stock you can buy. However, it should be noted that it is a real estate investment trust which has slightly different taxation around dividends in the United States. This will not be taxed at the lower qualified dividend amount. Instead, they will be taxed at the same bracket as ordinary income. This is true of all real estate investment trusts. However, if you're okay with that, then I do think this is a nice one to add to your portfolio. And right now it is undervalued by 12% according to the consensus price target among Wall Street analysts. VICI Properties, ticker symbol VICI. This is another real estate investment trust which just had a 4.2% dividend increase. VICI has less of a track record, only going public in 2017. VICI has less of a track record, only going public in 2017. However, it's quickly become a favorite among dividend investors. The forward-looking annual dividend payment is $1.73 per share, giving it a 5.23% dividend yield. The payout ratio is sustainable at around 70%, and this stock pays a quarterly dividend unlike Realty Income's monthly dividend payment. And part of the reason why VICI has been popular is their higher dividend growth relative to other real estate investment trusts. The 5-year CAGR of the dividend is 8.51%. However, this has slowed down in recent years, with the prior dividend increase being 6.41% and the new dividend increase only being 4.22%. So this does seem like a trend of slower dividend growth moving forward. It is currently undervalued by 9.28% according to the consensus price target among Wall Street analysts. And part of the reason why it's so popular among dividend investors is because it offers a unique set of properties, giving a little diversification away from the typical types of properties owned by other REITs. VICI is known for their casinos around the Las Vegas Strip, along with various golf clubs and resorts. So in terms of diversification, VICI does get you a little bit of a different side of the real estate market compared to Realty Income. So if you're a dividend investor who wants higher yield right now, then pairing VICI with Realty Income might be a good combination. Stock number 8 is Hess, ticker symbol HES. They just declared a 50-cent per share quarterly dividend, which is a 14.3% dividend increase. Hess is an oil and gas stock, so their earnings fluctuate dramatically depending on the price of oil. So from 2015 to 2020, they were losing money consistently. And then since the oil boom, they've been raking it in a little bit. And this has been reflected in their dividend payment. The company did not increase their dividend at all from 2013 all the way to 2021. But once the oil boom started coming in, they announced a 50% dividend increase, followed by a 16.6% dividend increase and the latest 14.29% dividend increase. This gives it a forward-looking annual dividend of $2 per share or a 1.49% dividend yield. And this is a stock I would stay away from because I do think it's on the riskier end from a dividend perspective. And I also do not like investing in oil and gas stocks during boom cycles because at that point you're basically pricing in all the positive earnings performance as of late. For oil and gas, I like to focus on buying them when the price of oil is depressed. And even then, Hess is not one that I would focus on. There are far better oil and gas companies in my opinion. Stock number 9 is Verizon, ticker symbol VZ. They just announced a 1.9% dividend increase. Now Verizon is one of the top telecom companies along with AT&T. However, both of those are extremely slow growth businesses. If you want to learn more about my thoughts on this business, then I recommend you go watch my AT&T stock review video, which just came out in the past few weeks. Much of the same applies to Verizon, although Verizon has not seen a dividend cut. They consistently grow the dividend around this 2% range, with the 10-year compound annual growth rate of the dividend being 2.11%. The forward-looking annual dividend payment is $2.71, giving it a 6.11% dividend yield. And the payout ratio is sustainable. And if you're only focused on dividend income, then Verizon may be a reliable, slow growth option. However, I don't think this will be good if you're looking to optimize long-term total return. Finally, stock number 10 is Lam Research, ticker symbol LRCX. They just declared a $2.30 per share quarterly dividend, which is a 15% increase. Lam Research is a semiconductor manufacturing company focusing on making the manufacturing equipment that is sold to these large fabrication plants. So their equipment gets sold to companies like TSMC and Intel, and they are one of the cutting edge companies in their space. So their equipment is in pretty high demand, which is why their earnings per share has grown dramatically over the past decade. And this has led to strong dividend growth. The 10-year compound annual growth rate of the Lam dividend is 29%. The 3 most recent increases were all at this 15% range, and this dividend payment is very sustainable at around a 20% payout ratio. The forward-looking annual dividend payment is $9.20, giving it a 1.19% dividend yield. And Wall Street analysts are projecting continued earnings growth into the future. By fiscal 2028, they're projecting $63 in estimated earnings per share, which would give it a 12p ratio based on current prices. If they can accomplish this, then I have no doubt the stock will see strong returns from here. The current consensus price target is $827.50, which is 7% undervalued based on current prices. Let me know in the comments if you'd like to see a full stock review video on any of these companies. And on my website, dividenddata.com, you can get this breaking dividend news for free. Link in the description and pinned comment. And if you sign up for the full dividenddata.com product, then you can get this dividend news filtered by just the stocks you own or track on your watch list. And on top of that, you can use the full stock research tool I've been showing throughout the video, as well as get access to my long-term dividend growth stock portfolio live as I make changes, plus my watch list and my top stock picks every single month. And remember to sign up for my free email newsletter where you can get breaking dividend news straight to your inbox every single Monday morning. And on top of that, you get tons of other great value like my stock analysis and lessons from investing legends. Link in the description and pinned comment. Thanks for watching and subscribe, so I'll see you in the next video.